Well, good morning, everyone, and thank you very much for joining us this morning. My name is Mark Bramridge. I'm Director General of the Enterprise Investment Scheme Association, or ESA as we're better known. Thank you for joining us on a bright and breezy Monday morning. You can see that I'm not quite back in the office yet, unfortunately. Hopefully some of you guys and girls are getting back into the office, and hopefully, fingers crossed, we're all getting back to some kind of normality, very much, if not now, then coming into the future. So look, today is the first in a series of week-long webinars that we're running this week at 10 o'clock every day, called Tidying Up the Tax Year End and Beyond. So we're looking a little bit backwards at the tax year end and what happened there, but certainly more for today at least, certainly into 2021 and what's happening with 2021. So this particular seminar, or webinar I should say, is called Budget, Brexit and Building Back Better. We've already seen that 2021 has been a busy year. We're already no longer part of the EU. We have finally fully Brexited. It's taken quite a while, but we got there in the end. We had a major budget on the 3rd of March, so we'll look at that. And then obviously the government is starting to formulate, in their words, what they call Build Back Better. So we'll perhaps talk about that and what that could mean going forward post-COVID-19 pandemic. We'll also look at the landscape for EIS and SEIS and early stage businesses in general and what part they could play in a post-pandemic economic recovery. And then finally, we'll look at what it means not to be not part of the EU and how that might affect some of the schemes and some of the companies that we deal with looking forward into 2021. Okay, so hopefully you guys and girls are ready to go this morning. We have 4 fantastic panelists here that you can see on your screens. I'll pass over to them to introduce themselves in a second or two. You're all Zoom veterans by now, I'm sure, so please do use the Q&A function down the bottom here, or use the chat function if you want to ask your own questions. We do have a big bank of questions that we're going to put to these guys and girls, but generally, your questions are better than mine, so please do use Q&A or chat to send through your questions as we go through. Okay, so I've spoken for way too long. Let me pass over to Zoe to introduce herself and go first.
Of course, thank you very much. Lovely to be here with you all today. So I'm Zoe. I am a principal part of the investment team at Octopus Ventures. For those of you that don't know, Octopus is one of Europe's largest venture capital investors, very early stage. We invest at seed and Series A into health, fintech, deep tech, and consumer businesses. We also look after, and I'm one of the fund managers for Titan VCT, which is obviously a different product than the one we're kind of here to talk about today, but we also have EIS products as well. And again, just a big supporter of early stage businesses. So here to give the kind of investors' view on some of these questions.
Brilliant. Thank you very much, Zoe. Howard, over to you.
Hello, I'm Howard Lee, Lord Lee of Hurley. I am the senior partner of Cavendish Corporate Finance, which is an investment bank in the specialist in M&A, particularly sell side. We're now part of FinCap, which is AIM's largest nomad, so cover IPO and M&As. I am also senior treasurer of the Conservative Party, amongst other things. So I sit on the backbenches of the House of Lords, where I speak regularly on finance, business, tax, and actually quite a lot on EIS as well.
Brilliant. Thank you very much, Howard. Dan, over to you.
Thanks, Mark. And firstly, thank you to you and ESA for having us on today. My name's Dan Rodwell. I'm Chief Executive of Growth Invest. Growth Invest is an advisor-focused platform that specialises in tax-efficient and alternative investments. So we work with advisors who bring historic tax efficient and alternative portfolios onto platform so that we can give them one centralized reconciled view of those assets. Thereafter, they can research and invest in a number of tax efficient products such as VCTs, EIS, inheritance tax and other private market products. And they can do that digitally and with the controls they need to grow this area of their business. So we, as you would imagine, big supporter of growth companies across EIS and VCT.
Good job. Thanks very much, Dan. And Tej, finally over to you.
Thanks. Hi there, I'm Tej Parikh, Chief Economist of the Institute of Directors. Primarily over the last 12 months, we've very much been in crisis management mode, supporting business leaders through coronavirus and coordinating efforts with the government, parliament, and in media. And hopefully looking forward, we can actually now start to put some meat on the bones of the plan for growth and recovery out of this recession.
Brilliant, thank you very much. So hopefully a balanced panel. We've got Howard and we've got Tej to look at kind of the bigger picture, a macro situation, and then Zoe and Dan to look a bit more at the micro situation of what's happening at a company level. So fantastic. So look, Tej, I'm going to go to you first. I left you last for the introductions because I'm going to ask you a question first. Do you want to just set the scene for us a little bit and explain to us what the state of health of the UK economy is at the moment in your eyes?
Yeah, sure. So 2021 and 2022 should be 2 years of quite rapid economic recovery. That's to be expected. Of course, like 2020, we saw a 10% contraction in the UK economy, and that was quite severe compared to our peer developed nations. And that's largely the result of the fact that, the UK is quite concentrated in kind of consumer-driven sectors that were, predominantly affected by lockdown. We also had a more stringent lockdown and lengthier lockdown than other countries. Notwithstanding a worse health crisis as well. But over time, what we've seen is that government measures, particularly the furlough scheme, has been doing a lot of heavy lifting. We've seen a lot of our members in particular have been adjusting to lockdowns over time, whether that's through investing in technology or just getting used to dealing with social distancing. So businesses have been weathering each lockdown slightly better. And effectively what that means is Q1 of this year, it should effectively mark the low point for 2021. We of course had the renewed lockdown at the start of the year. We had Brexit to adjust to, and that left the economy around 7 or 8% below pre-pandemic levels. But of course, over Q1 and what we're looking at now, we've seen the successful vaccine rollout. We've seen the roadmap to reopen the economy. There was essentially an avoidance of this cliff edge in government support following the budget and the announcements made there. So confidence has picked up. And following that big dip last year, it basically means this year we're going to naturally see a growth from lower base levels. And we're going to see this consumer-led recovery, which should see the economy return to the size it was pre-pandemic, essentially by Q1 next year. So we could see growth of around 5 to 6% this year, 7% out to next year. And things do look a bit better than when we were first trying to forecast things back at the end of kind of Q1 last year. So unemployment, it will naturally pick up as more people come into the labor market and look for work during the recovery, but it's certainly not going to reach the heights that we thought it would back in 2020. I should say there are kind of ongoing risks here. We know that a lot of SMEs and businesses have taken on substantial amounts of debt, particularly through the government loan schemes. Insolvencies to some extent have been kept low due to moratoriums in place by the government. So I think these are risks to look at going ahead. That could mean there is a longer term scarring on the economy. But I think, with all of that kind of positivity about the reopening of the economy, I think that the only drags really will be coming from businesses will be doing some balance sheet repairing naturally, readjusting their business models. Social distancing will continue to bite. I know there's an ongoing debate about, what place there is for social distancing, beyond the full reopening, if you like, in the middle of summer. And we know, obviously, looking at the news coming out of India and other emerging markets, I think the international environment would still be a bit of a drag more broadly. So, I'd say it's certainly more positive than it's been at any other stage over the last 12 months. And of course, this is all contingent on the virus and any new strains.
Sure. I guess it can't be any less positive than it was 2 or 3 months ago. But in terms of kind of, we've had 29th of March when there was some lifting the restrictions then, and then 12th of April, more lifting of restrictions. People are talking about kind of a roaring 20s going forward. Do you see that coming through at the moment? How has it been since pubs and restaurants have started to open again?
We've certainly, I've struggled to get any bookings at any pubs and restaurants, but I think retailers have massively kind of picked up. We've seen the data that's come out. We've seen forward-looking indicators of manufacturing activity and orders as well on the other side of things. So there's certainly been this pickup that we're experiencing. I think if it is something like, there has been commentators speaking about this, roaring 20s. I mean, I guess the big question is how much consumers will eat into the additional stock of savings that they made over the last 12 months. Of course, not everybody was able to make savings, but there has been a considerable chunk of households that have made additional savings. And if you do see consumers eating into that, then, you know, that could be an upside risk, and we could see a serious kind of surge and pickup in spending over the next 18 months.
Sure. And then you mentioned debt and furlough. Obviously, there's figures coming out saying that we're back to kind of wartime levels of debt at the moment. Do you see that being a big problem going forward? Do we need to pay down that debt? Can we pay down that debt?
I think the argument is, you know, with interest rates, you know, near historic lows, then really the government's kind of key aim is to at least ensure that the growth rate is above the interest rate, and therefore you are kind of eating into that debt and kind of eating into the additional incremental interest that you have on that debt. So I mean, that looking at the projections that the OBR made at the time of the budget, it looks like, you know, the UK's level of public debt, whilst it will reach record levels, it would peak and then gradually kind of tail off. And I think that's partly down to the fact that, of course, there was some measures in the budget to kind of recoup some of that through higher corporation tax and various other kind of things around thresholds and relief. So I think there were some measures put in during the time of the budget. The big kind of thing here is that the OBR was assuming that there would be a 3% scar on the UK economy. So that's effectively a way of thinking that there's some tax revenue that we won't be able to get back. And I think that's the thing that we're going to have to assess really where we are at the end of 2021. And my inkling is actually that scarring effect hasn't been as strong as the OBR considers it to be. And actually, we could be on a better path fiscally than I think the OBR are projecting.
Okay, brilliant. Well, thank you very much. That gives us kind of a one headwind to look at, which in terms of coronavirus and what's happened with that. Howard, moving on to the other headwind, which is obviously Brexit. We're obviously 4 months into a post-Brexit era now. What's your early analysis of whether there's been drawbacks, benefits? How do you think we're heading so far in terms of Brexit?
Well, as a Brexiteer, it's all going swimmingly. No worries there. And I was a Brexiteer. I was, I think, the only person in the Conservative Central Office who was probably, I think, the only person in Cambridge, certainly the only person in my family, and many other communities. But I mean, as Tej has said, I've actually spent some time reading, which I strongly recommend to you, the budget Red Book, which is full of fascinating things about the finance bill. And yes, we had a 7% knock, although of course, as Tej knows, you know, we measure things by outputs rather than inputs. So you can't really compare the UK to other countries because, you know, we count as a lost economy, children not going to school and people not going to doctor's appointments, whereas other G7 countries don't. I think the point that you make about debt interest is very important, because the difference between us and other developed countries of the world is that a third of our debt, a third of our gilts, if you like, are index linked. So as there are variables in interest rates, which I think there will be following what's happening in America, we will suffer more debt. So I think it's impossible to measure this particular impact on Brexit. It might have been if there wasn't a pandemic. It's impossible to say. The big prizes are yet to come. I mean, Liz Truss has done a fantastic job in about 60 FTAs that are in place. They already said it wouldn't happen, which have. The Prime Minister's trip to India, unfortunately, was put off, but that is clearly going to happen soon. And the big prize ahead of us, which people haven't focused on, is the UK-US trade agreement. And the UK-US trade agreement could change things dramatically. I actually went to the Republican convention in the States, Trump's first convention, and all the senators and representatives I met there were all saying, we want a trade agreement with the UK as a #1 priority. Yeah. You might have noticed a regime change, but nonetheless, the mood in America is very much to do, and Biden's first trip overseas, the UK. Yeah. And now if that happens, then the UK will be the place to come to start a business, because you will be able to do business in the US. And I see the UK as the place to start up a business, or certainly grow your business to enable you to benefit uniquely from a UK-US trade agreement, and of course the trade agreements we will have in place with the EU. the EU, who have, the vaccine procurement program has revealed the EU's true colours for many people, and many people have changed their mind and said, well, it's a good thing we got out of the EU because we're now free to do things we weren't. The classic saying, the US is a country of innovate and the EU is the place of regulate. And that's becoming more and more apparent. And the one area that everyone incorrectly criticized the UK, which is not having financial services in the FTA, which financial services are never in FTA, so there's a meaningless statement. But it's clear that the EU are backing down on that, and there will be, if not equivalence, then certainly the opportunity for financial services businesses to transact in the EU, as the City of London has not imploded as we were told. The jobs have not moved out of London as we were told. There's not been a huge outbreak of gonorrhea as we were also threatened with. So all in all, post-Brexit has not been quite as bad as we were told. To my mind, there is every opportunity to take advantage of post-Brexit trade agreements and trade generally in the year ahead. As Tej says, the growth projections for next year are 7%, followed by 4%, followed by a steady 1 or 2%. So I think we're sitting pretty, and there are some specific post-Brexit advantages that we need to implement. Perhaps we'll talk about them later. Specifically, I'm thinking of EIS and other tax opportunities, free ports, and so on. So that's where I see it.
Yeah, sure. Yeah, we'll obviously talk about EIS and SEIS and some of the CGT changes that are being considered, subsidy regime controls that are coming into place. But yeah, certainly it seemed very positive that the president's coming here to the UK first. That's his first overseas visit. I think it's here in Belgium, isn't it? If I remember correctly, that he's coming to first. But
well, he's doing a token visit to Brussels to try and show equal-handed, but first to UK, needless to say.
Yeah, show willing in that sense, absolutely. So yeah, fantastic if we can get these agreements in place. I know there's one with Australia that they're trying to tie up at the moment as well. So it all seems to be, touch wood, heading in the right direction. I guess the other thing we had recently was a budget back in March. How do you feel that was? How friendly was that, entrepreneur-wise, SME-wise? You talked about obviously being the UK being a place to start up a business. How did you find that?
Well, I've read this. I mean, if you don't want to read this, then I can always send you to the Finance Bill explanatory notes, which after the first 340 pages, you'll get the idea of. But in essence, what was the good thing about what was in the budget is what wasn't in the budget. And what wasn't in the budget was the capital gains tax increase that we all were worried about. And I won't say I led, but I was very much part of the campaign to keep capital gains tax down. I organized a letter which was co-signed by 2,500 entrepreneurs. I think we had some folk from Octopus. I think Chris Hewlett signed it as well. But anyway, we had 2,500 entrepreneurs signing a letter. I met with Rishi Sunak. I met with others, was trying to persuade them that a rise in capital gains tax wasn't appropriate. And as Rishi Sunak said to the chairman of the Conservative Party, Howard Lee better be happy that I've done this, but it's not forever. So it is possible that there will be some capital gains tax increase coming. Biden's paper recently has not helped. If the states put up capital gains tax to the rates they're talking about, even though it's completely different in so many respects, nonetheless, the mood music will change, and that's a thread ahead of us. So I think the budget was measured, sensible, had a lot of good things in it. I mean, despite the 305 billion deficit this year, he wasn't going to make it up by putting up capital gains tax. The only thing I'm worried about is that they've got rid of entrepreneurs relief and replaced it significantly by business asset disposal relief, which could be renamed bad relief. And it shows you the business asset disposal. It shows you that the mindset's gone, that they just lost the word entrepreneurs relief. So we have to get back to encouraging entrepreneurs to start up new businesses, incentivized by the tax breaks that they will get by so doing. But in other respects, I thought it was a measured, well-delivered and a well-received budget.
Yeah, we certainly felt the same. We felt like a bit of a recovery budget rather than a growth budget. And I assume there's going to be another budget at the end of this year where perhaps some of the more growth aspects might come into play. But certainly, yeah, it's good to hear your thoughts on the CGT changes. I know Many people watching this, many advisors, many financial planners were nervous about that CGT change coming into effect, and certainly entrepreneurs were at the same time. So it's good to hear that that has probably maybe not gone, but certainly been put on the back burner for the time being. Perhaps a good time to bring in.
For the time being the operative phrase.
Yeah, sounds like it. Sounds like it. It's always good to know these things, and certainly from a financial planner's point of view, that, you know, it's always good to be able to have an idea of what's coming next, so you can advise clients. It's always the uncertainty that's difficult with financial planners. Probably a good time to bring in Zoe and Dan on this one as well. Zoe, I know Howard mentioned there that Chris signed the CGT letter to government there. What's your thoughts on the kind of the budget and where we are now with early stage investors and entrepreneurs? Obviously, you deal with hundreds and thousands of them. So what are they saying to you at the moment?
I think Howard's kind of nailed the main point. For us, the main stakeholders we worry about, of course, are first and foremost our entrepreneurs who we invest into. And for them, not only do we want the UK to carry on being a place where they want to start up and scale up their businesses and to continue to attract capital, not just from us, but from all around the globe, as well as talent. But we also want them to not be inhibited from doing it, not from putting the risk on the line. And when you had some of the discussions, not just around entrepreneurs relief, which has changed in name, but is kind of, again, I feel like a leading indicator of perhaps where we're going. The same with capital gains. That's when we start getting worried, because we're like, whatever happens, we do not want people to be put off. There's enough going on, and there are arguments still that we're still only 4 months, I guess, post Brexit. There's enough going on to put people off from taking risk, particularly post pandemic, without bringing in additional tax legislation, which would make it harder and less appealing to go through that journey. And for us, we wanted to carry on being exciting. So actually, I think broadly positive, because, you know, there wasn't any big impact. The schemes are still in place. We can still carry on investing on behalf of kind of the retail investors who come in and get the tax advantages as well. And we can carry on stimulating the economy that way, which was great. I think the worry is more kind of in the years to come. You know, that was a month ago. Who knows where this is going to go? But for me, it's very important that kind of, and you saw Chris, one of our founders, he signed that. You know, we don't want folks to be taking this much risk and then not getting the upside of the reward. You know, they are bringing in jobs, they are keeping the UK a place to be. So for us, broadly positive, but would like it to continue to stay as such.
Yeah, I guess it's nice to see that kind of movement towards that. But yeah, certainly for entrepreneurs, you know, what's the point of starting up a business if you can't get something at the back end of it, or you employ people, you put money into business, put your heart and soul into the business, quite frankly, you need to get some rewards at the end of it all, I think.
I mean, 100%. And you will all know that they're not small journeys. These folks are, you know, going into this for a decade. They're putting lots and lots at risk at a time when, you know, the globe is pretty uncertain. They could just go and take, lots of them, a decent job in the city and not do this. And it's essential that we carry on having these small businesses that start up and you know, carry on what is going to be a really successful time. Actually, I mean, with it, Octopus, we've got some great businesses coming out over the next few years, which are really going to cement the UK kind of on the world map. So in terms of the size of them, finally competing with the States and Asia. So yeah, would not want that to change at a time when the tailwinds are great.
No, absolutely agree, certainly. Dan, Zoe's covered also the entrepreneur's point of view there. Just going back to the financial planner's point of view, what are you seeing, what are you hearing from advisors at the moment in terms of the budget, in terms of kind of the wider economy? What's the mood music out there?
So, I mean, firstly, to agree with Howard and Zoe, you know, entrepreneurs relief is a big thing. The UK has to remain the place to come and start a business. You know, it's fundamental to our growth going forward. The budget itself, you know, from an EIS and SEIS perspective, was relatively benign. You know, there were mentions of the schemes in the Build Back Better document, so I think that's heartening for advisors that look to use these schemes. I think, you know, from a investor appetite and confidence perspective, I think, you know, that what we saw is early in the pandemic, we saw, you know, some inertia, as you'd expect. You know, people's wider portfolios were volatile, to say the least, and people were just sitting back to see how this plays out. But, you know, kind of as you'd expect, and as we saw back in 2008, when you have, you know, macro events such as this, the high net worth end of the market did come back more quickly. We certainly saw confidence on that side. Financial planners and advisors quite rightly took a slightly more cautious approach, but what we've certainly seen in the last few months from advisors is, you know, renewed confidence to come back into the scheme on behalf of their clients. Yeah, you know, across the market, I think we're seeing certainly fundraising amounts that were above the previous year, but in many cases record fundraising. So I think it's a real positive, and I think that the supports have done their job to an extent, and hopefully they will continue, so that confidence stays out there.
Sure. And the CGT campaign, obviously Howard's led by the sound of it. From an advisor's point of view, certainly we were seeing, talking to a couple of fundraising firms, they were seeing large inflows of money on the back of that CGT potential rise. People trying to get out of assets and reinvest into EIS before those changes came in. Have you seen that yourself? Has that kind of been something advisors have been talking about?
It's definitely been on the radar, and you know, we did see there was a kind of blip there just in case there was, you know, a draconian approach that this was brought in early. But I think before that became, you know, too pronounced in terms of flow, I think, you know, rumours got around that maybe you know, that Howard's letter had been well received, and that this thing is going to be moved further back. But it's most certainly on the radar, and you know, whilst it's obviously not a good thing for the end clients, but I think it's going to be a real positive for EIS and the wider tax efficient industry.
Sure. Okay. We've had a question come through, and as our resident economist, it's probably one for Tej. So Tej, will recent aggression from Russia help cement better trade relations and a US deal being reached sooner rather than later? And where does this leave us in terms of EU relations, given that the EU seemed concerned at any UK success?
Yeah, well, I think feels like more of an international relations question. Yeah, I mean, I guess as Lord Lee kind of outlined, it looks like the US is, you know, generally, you know, keen on supporting the UK and kind of doing deals with the UK, and it looks to be relatively at the front of the queue. So, you know, I think regardless of what's happening on the Russian front, I think, you know, there's always going to be that strong tie-in between the UK and the US. I mean, I guess the kind of bigger picture thing around this is how you manage that relationship alongside China. So, I mean, I think for all of these nations and blocs, for the EU, US, UK, and their interrelations with China and how they trade with China, and whether they restrict investment from China, I think that's always also going to play in on how these trade deals are done. Because I think a lot of them are, you know, the US in particular, despite the change in regime from Trump to Biden, there still seems to be some reticence around the Chinese relations, and that might be kind of a marker for how it does deals with other countries.
Sure. I'll give you a question that's perhaps on firmer ground for you from an economic point of view. So I said earlier, the budget felt like a bit more a recovery budget rather than a growth budget, and that may come in the future. What sort of things are you at the IOD looking for entrepreneurs from the government? What measures would you be looking to put into place, or what are you championing at the moment?
Yeah, I think certainly this budget wasn't really, they probably didn't have the space to be thinking too long term, and the initial aim of this budget was to shore up the recovery, to extend the government schemes, which was obviously something that we were very much encouraged by. We didn't want to see a cliff edge. I think over the next 6 months, and, you know, assuming things are as they are with the roadmap to reopen, and you know, we are kind of reopened as an economy, I think the things we're looking for really are government to take a bit more of a systematic approach to the way it looks at entrepreneurs in this country. So, I mean, I'm not saying every startup needs to turn into a scale up, but just if we look at the kind of journey from startup to scale up and understand the various pinch points, I think that's a good framework to then understand how you then look at supporting policy in various areas. So I think the first area is certainly an emphasis of ours is around skills. We saw the Help to Grow scheme from the government, which essentially provides management or MBA style learning for SMEs that can apply. Something like this is useful. I guess like looking at how we can get mentoring and coaching, more firmly into the entrepreneurial landscape would be important. Of course, the big aspect here is finance, and I suppose finance that isn't just London and Southeast centric. So looking at finance across the country, the British Business Bank have been doing, they have a number of schemes in this space, but there is obviously a need to kind of look at SEIS and EIS and what role that can certainly play. And I think more broadly, just looking at the tax system and investment incentives that we have, there's obviously some consultations open at the moment around R&D tax credits and whether definitions can be expanded and whether it could include the scope of digital and green investments to support startups and entrepreneurs in that space. I think the last kind of areas that are obviously going to be important are the institutions to support the rollout of better skills and finance. So LEPs have been patchy, I suppose, in England, and I think they do provide a useful platform to support regional entrepreneurial growth. But I think we're kind of missing a trick in the UK, which is, we have world-class universities pretty much dotted around the country, and they can become, invaluable hubs to support, to connect the research and the development, which is what startups and entrepreneurs do. And I think there's something to look at there. We've had various schemes such as university enterprise zones in the past, but I think there's definitely some work to be done on how universities can become a hub. And then I think more broadly is just looking at the business environment. There's some debate around the UK's digital infrastructure holding back the digital economy, and I think investing in that, particularly in rural parts of the country, is going to be important to maintain our competitiveness. I think reflecting on the immigration scheme and where we're at, and particularly small businesses and their ability to attract talent from abroad will also be a key aspect too.
Brilliant. Thank you very much. It's a good summary there of the things that you're looking at the IOD. So thank you very much there. I guess Howard, similarly, you already talked about being a champion of entrepreneurship. What would you like to see come in? What measures are you thinking might be able to help some of these early stage companies?
Well, the thing I'm particularly fussed about is that the EIS and SEIS schemes, which have been so successful, are actually extremely restrictive. So there are limits and exclusions that are unhelpful. And drilling down into them, it transpires the main reason, as far as I can tell, for these limits, caps, and exclusions are restrictions put on us by the EU state aid, which of course our civil servants have gold-plated and insisted that we do. And for example, the restriction that you can't have EIS relief if you and your family have more than 30% of the stake of the company. Well, my daughter's just started a brilliant app with a friend, and needless to say, she's invited me to help her, and I will. But I can't do it under EIS because she's got 35%, and that's that. She, as my daughter, she's deemed to be family, so I'm going to have to do it by a loan or something, and it's not tax effective, and that defeats the whole purpose. Another EIS I invested in was very successful and grew to the point where it needed corporate investment to help it to the next stage. The corporate partner insisted on 50.1% of the equity, and in so doing, immediately lost the EIS relief. Sadly, a year after the PLC changed its CEO and decided they didn't want to do this anymore and pulled the plug, and it went bust. So not only did I lose the EIS relief, but I lost the write-off as well. Yeah. Wouldn't be appropriate for me to name the PLC, even if it was Tesco. But so those sort of rules need to be looked at again and considered. What's best for the UK, and what can we do to encourage before the Octopus Series A even, and before the real seed type money, the 10, 20, 50,000 pounds, what can be done to facilitate friends and family? Because these sort of investments are going to be a leap of trust, and they are going to be without any assets, and they are going to be completely speculative. So fine, let's do it, but let's allow the people to have some help fiscally, so to do.
Yeah, certainly seems like a great opportunity. I hope now come out of the EU, not part of EU state aid, with the coronavirus obviously pandemic happening, it seems like a great opportunity to revisit those EIS rules and see, not perhaps tear it up and start again, but certainly remove some of those restrictions or kind of pare it back a little bit, and or ask HMRC to be slightly more open in their consistency and how they're looking at these type of applications. So yeah, very much that's something we're campaigning for and lobbying for towards, well, the rest of the year effectively.
Well, can I, whilst I'm on the soapbox, can I invite all participants here just to drop a note to their MP email, easy, just to mention to their MP that this is something that you think, as a financial services advisor, so you know what you're talking about, that the government should be looking at. It really does make an impact. It really, they listen, and volume speaks a lot. So if you get a moment, just drop a note to your MP to say, are you looking at revising EIS to allow for British businesses to raise capital at their beginning? That'd be really helpful. Thank you.
Brilliant. Thanks very much. And similarly, we have a petition on our website, so if you want to go on there and sign that, then we'll add that to our list, and we can send that to MPs as we very much plan to. Zoe, Howard mentioned there Octopus in name, in terms of the kind of work that you guys do, not just with funding, but also helping companies and supporting them. Just want to tell us a little bit about how you actually not just give those companies money, but how you mentor them, how you work with them, and try and get them to go from start up to scale up.
Of course, it is a wonderful part of our job, but of course it is very, very time consuming in most of what we do. So yeah, we are not just capital. I think if you are any sort of a early stage investor, it's kind of table stakes that you can offer capital. So offering capital is bare minimum. That's great. That's wonderful. But these entrepreneurs come to us and folks like us for far more than that. Of course, they are generally on a journey with us for minimum of 5 years, sometimes 10. And that means that they need help with everything from, and Tej has touched on this earlier, so recruiting a team, first of all. So a lot of these, let's say for me, for example, I work in deep tech, I work with a lot of university spin-outs. They've been in the lab, they're lots of R&D heavy businesses, but they haven't yet attracted a commercial team. They haven't yet understood how an organizational structure works. So we very much help kind of putting that team in place. That's not just at the exec level, that can also be on the NED side, having a sensible board, having some kind of industry experts around them. That's what they need. They also like to look, and what we're so privileged about in our ecosystem now is that there are entrepreneurs who've been the whole way through the journey. So they've started, they've scaled, they may have even exited here through IPO, direct listing, maybe they've even de-SPAC'd in the current environment, but they will have folks who they can then speak to who have gone through that, who basically can say, right, at this stage, at this inflection point, this is what you're going to need to build around you. And we, of course, try to keep those people within our own kind of ecosystem, and they like paying it forward. Even if they've gone across, let's say, to the States, a lot of them are now looking to come back to Europe to say, look, let me bring my learnings back to you about how you do this. We also, not just ourselves as capital providers, we realize that there will be other capital providers, not just in Europe, but in the States, across the globe, who will be looking at these businesses, both financially and from a corporate perspective. So it's really important for us that we have a pulse on who those future capital providers will be, but also who those customers will be. So we're all, BD, Corp Dev, whatever it is, we are there to kind of effectively be their network, and to bring in those expertise, to surround those folks, and to really kind of help them on their journey. So like I said, capital is kind of minute one, but skills, future capital, customers, team building, that's really what we're there for. And of course, we're there to be like, and this is perhaps very obvious, but human with these people. Like, these folks give up their family life, they give up literally having a division between work and life to work on this all the time. So we are there to be almost a mental health coach, cheerleader, you name it. We're there to kind of do the highs and lows with them, because we all know that early stage has a lot of failure associated with it. It is a real roller coaster. And so it's really important that as kind of their capital provider, you also are a human who understands kind of what they're going through on that journey. So hopefully lots more than just money.
Yeah, sure. So literally you're the first person they pick up the phone to if they have a problem or not quite sure what to do.
I have definitely had some tears, Zoom tears during Corona, as I'm sure everybody has experienced, and they've been, but I've also had some absolutely amazing successes to live with these guys through. So yes, we are on WhatsApp, Zoom, you name it, whatever technology channel, we're there.
Yeah, there's way too many these days. That's the problem, exactly. It'd be nice to get back to a normal face-to-face meeting. Dan, and then to you guys, obviously, because you have single companies on the platform, you have funds on the platform, I guess you see the kind of the whole plethora of investments being made. Again, any trends that you're seeing at the moment in terms of single companies or how they're raising or types of companies or sectors?
Well, I think I'd like to kind of reaffirm Zoe's points there. What we're really seeing around the fund side, because that is very much the core of our business, is over recent years the amount of active management that comes from EIS funds has increased dramatically. It's moved from historically being a non-exec director and some good governance controls around companies to, as Zoe said, to the extent of being a counsellor or just a voice at the end of the phone. And I think something that's really worthy of note is across the last 12 months and the COVID pandemic, how involved the industry, the managers across the EIS space have been with these businesses, and whether it be giving them advice around accessing supports or just helping them through tough moments, or indeed how to address real opportunities of scale if they're digital. It's been something we have seen firsthand across our portfolio of funds, and been really impressed with at a moment where I think at the start of the pandemic, advisors, platforms, investors alike, everybody kind of sat there and thought, crikey, what's going to happen to all these growing companies in this industry? We've definitely clutched victory from failure there, and it's all down to the active management of the fund. So I think that's absolutely worthy of note right now, and what we're going to see is that the fund managers have driven much better outcomes across the last 12 months, and will continue to do so.
Sure. I think you touched on it earlier, but in terms of kind of fundraising for 2020 tax year, what did that end up looking like? Is it kind of up, down, the same?
Yeah, 2020 was down, from an EIS perspective. I think, if you kind of split the venture side of the industry, VCT, that season tends to start a bit earlier. They don't have the benefits of carry back, so the bulk of the flow, dependent on when the big managers, namely Octopus and those guys, are open, the bulk of the flow sits in Q4 and the early parts of Q1. So I think VCT was less impacted in 2020, most certainly. I think EIS did struggle because the advisors will tend to start looking at EIS cases as we approach April 5th, having done their VCT business, and that was just when we entered the global pandemic and lockdown. So numbers were certainly down in 2020. I would say the VCT season this year has been phenomenal, and all managers hitting capacity really quickly. There was only so much capacity, but we think next year could be another record year. EIS has been really positive, as I touched on earlier. I think I've not heard any stories of managers not raising assets at or above their 2020 levels, and the vast majority have had record years or close. So I think there was a bit of dry powder. The industry talks about dry powder within venture capital. I think there was dry powder with advisors, planners, and their underlying clients. And I think I don't think it's all been mobilized yet. I think we've got another very positive year to look forward to, but I do think that confidence in the sector came back with a vengeance, and that's a very good thing.
Sure. I guess if we're going to mention VCTs and what a phenomenal year it's been, it's probably a good time to ask Zoe, because because Octopus had the biggest one out there. So again, I guess Titan has raised super amounts this year again, has it?
Yeah, raised exactly what it wanted, and it's over allotment and closed its early. But to talk about market exuberance and kind of the portfolio, so we had our net asset value down at a low given Corona and provisioning at kind of 88 pence last April. We just announced last week it's at 105.5 pence. So, you know, 26% in 12 months it's going through a spectacular period. I think that there will be 3 or 4 unicorns announced in the next kind of 2 quarters. So that's that, and that, you know, yes, I would like to say that Octopus is wonderful, we are, but that's not just us, you know, that's the market. There's, like to Dan's point, it is coming back. There's strong belief, there's capital pouring in, obviously into good assets, but it's and I think you're right about EAS. I think that will follow. I think we started seeing it kind of just pre-tax year end starting to tick up, and with our new product, which kind of co-invests along our VCT, we're also seeing kind of interest in that now coming back. I think, you know, folks up and down the spectrum were kind of sat on their hands, kind of waiting to see what would happen for a while before they start deciding where they put kind of their investments and what they should go into. But, you know, we've seen technology assets in particular, like the adoption of technology accelerated by a decade more than ever before. So it's a great time to kind of be in it. But I think, yeah, cautiously positive is where I'm sat at the moment.
Place to be, I think, always cautiously positive. But I think it just goes to prove the point that we've making all through this webinar, that the schemes really work, they deliver, they get money in, they deliver it to companies that need it, that scale up and go on to be successful. I think we go back to the point that Howard and I talked about earlier about if we can expand the schemes, then, you know, there's a multiplier effect there. If you've got more money to enter, you've got more investors to invest more money into more companies, then you can multiply that whole thing. We know when we do our research that for every £1 million that EIS invest, it creates at least 6 jobs, and that's just in the first year. So, and there's a whole other multiplier effects there, not just in terms of jobs, but in terms of revenue and how much tax is paid by those companies, so on and so forth. So I guess one of the other things I wanted to talk to Howard about was kind of the subsidy regime. Obviously, we've moved out of EU state aid, which, as I said earlier, was one of the kind of barriers or blockers to extending the scheme. The UK is looking at perhaps bringing in its own subsidy regime, and that may or not include EIS and VCT and the other forms as well. What's your thoughts on how that subsidy regime might be? How light touch should it be? How heavy touch should it be? Do you have any thoughts on that, Howard?
You mean a subsidy regime in parallel to EIS, or do you mean an industrial subsidy regime?
Well, I guess we can cover both if you wanted to. But, yeah.
Well, I mean, the latter is quite interesting. I mean, the government is clearly against state subsidies for manufacturing, industrial, and very many other businesses. Having said that, they've just splashed out vast sums of money into businesses in what they call loans that are completely irrecoverable. And I spent quite a bit of time trying to persuade governments to think about, well, what happens to these loans that are irrecoverable? Why are we not looking at some sort of equity scheme to replace those loans? And I actually had a one-to-one with Rishi about it, and I said, what you need is a current 3i model, as 3i was when it started, when in the 1970s, when it took small stakes or small sums of money. And I said to him, personally, I thought the only organization capable of achieving that was BGF, because BGF has the national spread. It's got execs who are experienced putting in £2 or £3 million in equity into businesses, which is not something that most people want to do because it's teeny sums of money in terms of fees. Anyway, to cut a long story short, his strong view is that he does not want the government to be holding equity in SME or other businesses as a matter of policy. He just doesn't want to do that. He then came up with the Future Fund, which is clearly instrumented by Richard Sharp, because it's got private equity Goldman Sachs all over it, and that's so the private equity community were taken care of, and I'm sure that's a good scheme for some. But there is this gap in the middle of SME companies that have taken on debt, and how the hell are they going to repay this debt? How the hell are they going to find the resources to deal with it? So it is possible that there will be, and I actually gave the IPA, the Insolvency Practitioners Association, annual lecture this year. It is possible that there will be a very large number of companies going through some sort of insolvency exercise in the next few months, because as you know, most companies face insolvency as they come out of recession and they overtrade, and they have to get in stock and they build up, and it all ends up in a nasty cash crisis. So in addition to the zombie companies, you've got the overtrading companies, and investors need to be very wary about this. And some will need to be fleet of foot and ready to invest equity very quickly in businesses that need it. Wearing my FinCap hat on, we've had all stockbrokers have had a fantastic year, as equity injections have been the only way to survive, particularly for tech companies, and those companies on AIM have done very well. And AIM has come back into fashion a bit, having been in the doldrums for years. So I don't see the state much interested in anything like subsidies. I think there's going to be massive write-off of loans. And I think companies are going to have to find other ways of raising equity. And that has to be the focus here on in, which for you guys is very good news.
Yeah, well, not necessarily for us, but more for the companies, hopefully for investors trying to raise.
Well, you guys as investors, I mean, I think there'll be companies who are desperate for equity, sensible businesses, some go through a cash flow crisis. The banks or the various forms of debt that are out there now won't be in a position to assist. And I understand why, but I think there could have been, I think British Business Bank could have been slightly more fleet of foot and could have helped organizations like BGF put more equity into the market. But we are where we are.
Yeah, it's an interesting one with the Future Fund. Certainly that was kind of my own personal view, that Future Fund was aimed more at those later stage companies, kind of shoring up individual portfolios, probably private equity deals, as you say. But actually what it missed out on was some of the VC deals that perhaps, you know, Dan and Zoe deal with more on a day-to-day basis. It was those companies that didn't have anything. They might have got a bounce back loan, but that last 5 minutes, quite frankly, you couldn't apply for Future Fund. You may or may not have got C-bills. You probably didn't if you hadn't raised before. So yeah, if you're trying to raise for the first time, particularly, it was a very difficult environment to try and get equity growth into your company. So it'd be interesting to see what the government does next in that sense. Howard, I know you wanted to talk about also the bill that's going through at the moment as well, if I remember correctly.
Oh yeah, well, just to mention that this national security and investment bill that's going through at the moment will have a big impact. I mean, my day job is selling businesses. I don't think I've sadly sold any for Octopus, but I'm working hard on it, or others. But
it's a challenge.
But the national security investment bill will affect you, because you as investors, because so many of you have investments in tech businesses, and essentially it's a prohibition on. It's essentially the Huawei bill, although it's not called that. It's essentially to stop businesses being sold to Chinese investors, although that's not the public what's said. So here on in, and in fact retrospectively from November, if you are selling a business in certain areas such as AI and other tech, or where they have a bit of their business in tech, you will have to go to get permission that the purchaser is an appropriate purchaser, and they have 30 working days to make up their mind, which is a long time. I managed to get the de minimis from 15% up to 25%, which is helpful. But if you're selling 100% of the business, you'll have to go through this process. And M&A bankers, investors, many others have not got their head around the importance of the National Security Investment Bill, which will be enacted as quickly as this week, probably before prorogation of Parliament. And it's a biggie. So watch out for that for companies in your portfolio looking to exit. Make sure you thought. Have you seen that? Have you seen that ahead of you, Zoe?
Yeah, so because I look after our deep tech companies, it touches all of them. And we have been preemptively trying to speak. So, because obviously not just a full exit, but we're often investing and, like, you know, getting a 20-25% stake. And much like kind of the CFIUS bill in the States and lots of other like protective legislations coming across Europe, we've been trying to talk to the government, say, well, can we now, because you're going to retrospectively do this, can we get some sort of preemptive approval of who's investing? And obviously most of the time it's a classic European investor, so we're fine. But there are certain assets where, of course, we've got folks from jurisdictions which might not necessarily be that acceptable. And I'm not necessarily just shouting out China, but, you know, they're definitely grey area. There'll be assets of you know, perhaps strategic or security importance to the UK, where they're going to be taking this investment, and we're trying to get preemptive approval. They won't come and talk to us about it yet, unfortunately, which is really difficult, because you can imagine then in November this comes in and they say, well, actually, you know, that asset is actually important to us. That will be slightly difficult. I guess I totally get it. I think we do need to have a level where these assets kind of are remained here. It will be really annoying for deals like that, will just take them longer. But more than that, I think for us, where we suffer in this country is kind of later stage capital, and perhaps therefore being able to carry on scaling and getting to the big exits. What we don't now want is this to be so inhibitive that we are never going to be able to like get these exits, because, you know, that's why these entrepreneurs build it. That's, you know, that's why we invest. We don't necessarily invest to be in it for 20 years. And so it'll be interesting to see how they strike the balance. I think happy to go through like a CMA process, happy to notify, but if it becomes super interventionist and these deals start getting kicked over, it'll be interesting to see whether that carries on being a great place to kind of be building a business when you don't have an opportunity for liquidity in any other way, perhaps with later stage capital or otherwise. So I think you're so right. It is front and center of my mind, but I think perhaps it's not necessarily as permeated as it should be amongst the wider community.
Sure.
Well, I mean, if it was like CMA, that's not a great precedent, because CMA put a lot of people off, is what they've done. Exactly. What we were trying to do is to get it more like the takeover panel, which does work. Takeover panel is really efficient, because you can have informal chats. They guide you. They're practitioners who do it, and it's not civil servants. It works really well. But I'm not sure we have got a commitment. I've got a letter from the Minister, Lord Grimstone, to a few of us, that promises market guidance notes that will be helpful.
That would be amazing.
It's all early days.
Because to your point, if it's more like a chat or more like a takeover panel chat where you can get someone sensible on the phone who you can kind of actually have a Q&A and see what you're doing with, that would be far more helpful than sitting on your hands for 30 working days trying to guess what's going on.
Yeah, there's always something to be lobbying for and looking to change, isn't there? I was going to ask about the Lord Khalifa report as well, but we probably haven't got time to go into that and how that's going to affect IPOs and takeovers. But yeah, sounds like that's all for another session. But just hitting up to 11 o'clock now, so I don't want to be a time thief and taking everyone's time, so we'll end it there if that's okay with everyone. So just leave me to say thank you very much to all our panelists today. Thank you to Zoe and to Tej and to Howard and to Dan. There will be a recording of this available afterwards. We'll have that up on our website. And then do please join us tomorrow at 10 o'clock again. We'll have another webinar. This one's all about ones to watch, fund managers to look out for in 2021. So please do join us, as I say, 10 o'clock tomorrow for that one. Thank you very much for joining us today. We will see you all and do it all again tomorrow. Thank you very much.
Thank you, Mark.
Thank you.
That was